All right, guys. Testing 1 2. We are back. Welcome back to Smart Money Friday. I'm Tony Trades. This is the Tony Trades channel. And while we wait for some of my charts to display, it's quite interesting to see what is coming up. Now, if you're new here, click the like button, subscribe. Today, we're going to uncover one of the most misunderstood realities in trading. All right, this is the quiet. How do you get this off? Let's see. All right, there you go. All right. So what is happening here? Could you please write a comment if you can hear me well? I'm having some trouble with my browser. I'm having some trouble with my browser, and I'm trying to get that. So apologies for the technical issues that I'm having. Today's a very beautiful day over here. And I'm trying to make sure that we have an exceptional live stream. But for that to happen, I need to fix this technical hiccup that I have here. And there's no other better way to do it than to get your feedback over there. Now, what I'm going to do now is I'm going to try and revive this. So one moment. There you have it. It should work now. And I should be able to sign in into my... There you have it. Wonderful. All right, we're back. Now, guys, very quickly into the fundamentals. Today, we're not going to waste a lot of time. You see, quiet markets. This week, we haven't had anything quite significant. Just we had on Wednesday, we had CPI coming in. Today's 31st. So we are going to go through the economic calendar very quickly. And we had FOMC statement on 21st. We had we had a forecast of 4%. Now it became, well, it was 4%. This was a reduction by 0.25 basis points. And, CAD, we had the Bank of Canada, Central Bank, and that's pretty much it. Now, Wednesday, besides GDP for Canadian dollars, we have nothing much. Now, that is why I themed this live stream as Smart Money Friday. Now, whenever we have quiet markets, it's not just quiet, right? They're engineered markets. Every time you see something or nothing happening like today, okay, something is happening. It's just that it's not on your level of visibility, all right? And that's what we're going to talk about today. Now, when fundamentals go silent, all right, institutions are simply positioning themselves. And I like to look at it like an eagle flying up in the sky, looking across the ground. It can see everything. Now, they're loading orders, they're designing liquidity traps, and they're constructing opportunity before the next week's volatility. Now, today's session is not about just entries and exits like how we've been doing, right? It's about perception, understanding how the smart money, or rather the big institutions, look at price. I want you to start thinking like liquidity engineers, right? We're not just retail participants. So first and foremost, let us define what smart money is. To a layman, smart money doesn't mean people who are just smarter than you, right? It means entities or institutions that move capital with leverage, right? They have information and intent. These include central banks, we have investment funds, we have market making institutions, we have high frequency liquidity providers, we have algorithmic liquidity balancers, so forth, right? Now, these players are not just trying to predict price. They're not. They're not trying to predict price. They're creating price behavior that helps them complete large transactions with minimal slippage. If an institution on a bigger time frame, like say a day, moves price with all the leverage, it will be very visible, right? Visible. Now, in order to mitigate that, they have to get in slowly. They have to accumulate. That's why we have some of these terminologies like accumulation, distribution, and so forth. We're going to talk about that very briefly. Now, these players are not trying to predict any price. They're creating price behavior that helps them complete large transactions. They don't see a candle like how me and you are seeing this candle, for example, on the Euro USD. Institutions don't just see that, right? They see flow imbalance, right? They don't see resistance like you and I see it. I'll just draw those lines really quickly. Two horizontal lines. We have, say, resistance up and we have support. They don't see that, right? For resistance, they're pretty much looking at a pocket of retesting their liquidity. So they don't chase any momentum. They just simply engineer it, and that's it. At the institutional level, it's very different, right? Retails, we pretty much are at the end of the barrel. Like we don't get too much. So when you as a retail trader think that the market is consolidating like this, they see a warehouse of liquidity. They see opportunity to get in. Right, now we keep talking about liquidity. Let's define what liquidity is, right? Liquidity is simply the ability to transact large orders without significantly moving price. As simple as that. How do I move from A to B without moving any price significantly? I need to engineer it slowly, right? But you see, in trading structure, liquidity represents clusters of stop losses, right? We have stop losses below lows. We have limit orders and emotional entries, right? It's fuel. If you just think about it in a layman's language, it's just fuel. Fuel that drives institutional candles, the longer candles, right? Those big, gigantic pump orders, right? It just drives institutional candles without liquidity. They can't move billions of dollars through the market efficiently. Remember, we're looking at a highly liquid market. Forex, we have crypto. There's a lot of money on the table. Now, let us now get into, say, the details of this. But before that, I want to share with you this promo code, TSTREAM. Use this promo code on your fast deposit. You'll get 100%, and that is pretty much leverage. You need that as well. If you're a newbie here, you could sign up, join my Telegram channel. We talk about all this. I've got a bunch of tools for you out there. You don't need to pay a penny. Just get on there, ask questions. We're building a community that is sustainable, people that are ready to learn and grow. Now, let us start with a very quick one. I want this to be brief but fully packed. We have one more session coming in and we'll move forward. Probably we'll have one trade for you. Now, every 24 hours, institutions run a liquidity cycle. If you haven't heard about that, well, listen to somebody way experienced, somebody that has worked for these institutions. Everything is really scheduled, it's programmed, and we have templates for that. Now, the liquidity cycle has accumulation, right? They accumulate, they manipulate, they distribute, and then they rebalance. That's where you hear all this funny concepts coming in, like smart money concepts. You have the fair value gaps and whatever mumbo jumbo is out there. But what they're trying to say is they've broken it down to a retail level, a primitive level that simply shows you how understanding this rhythm means you just stop reacting to noise and you start reading it with intent. So the way that I view this chart, or how a newbie, or rather when I just started trading, is not the same way as I see it now. Now, first things first, we have the Asian session. Before you even start, you need to understand which time zone you are in, all right? We always look at New York time. Remember, we have Asian session ranging from 6 p.m. to 1 a.m. New York time. Everything should be New York time, right? Now, you could draw those demarcations on any instrument. Let's just say, okay, let's use the USD card. Now, you want to change the time zone on your side. I'll leave you that to figure out. But Asian session is pretty much from 6 p.m. to 1 a.m. New York time. This is the accumulation time, right? And it's very easy to see this on a bigger time frame. So if you look at the 1 hour, you could easily see where accumulation is. And 5 out of 6 times, it will be the Asian session. It's very quiet, all right? It's very quiet, very narrow ranges, like these, very narrow ranges, as you can see, right? And if we draw vertical lines here, you will be able to see that there is it's in a range. It's in a range, all right? When you get time, check out New York session. It has equal highs. If you zoom this, equal highs, equal lows appear not random, okay? These are magnetic liquidity zones. Now, banks usually set pending orders right here to absorb volume, and they pretty much determine or define the trap. Now, once you've marked out your highs and the lows, all right, you could move on to the London session. Now, London session, according to New York time, is between 2 a.m. and 6 a.m. 2 a.m. and 6 a.m. That is where the manipulation and expansion occur. Now, if I'm looking at it from where I am now, we'll see that, one moment. From, let's see, we have 9, very well. We got, all right, we have 9. Yes, we have 2 a.m. all the way up until 6 a.m. Okay, and there you have it, all right? You have your London session. Now, if you back test and look at this from a bigger perspective, like we're looking at 4 hours, London session is where price breaks the Asian range. It usually breaks the Asian range. For simplicity, you want to get a nice clean chart, right? You could remove all these indicators, and just look at these charts when you have time. London session, we have breaking of the Asian range to harvest the stops from the Asian session. Then they reverse, right? They reverse, as simple as that. After the Asian session, we have the harvesting of the stops. We have fake outs creating energy for real moves, and then retail usually gets trapped. Now, retail usually gets trapped between London session and pre-New York. So we're looking at those traps right there. This right here between, let's see, between, there you have it, between 10 and all the way up until say 13, that is 2 to 6 a.m. New York time. These are usually traps. These right here. And the more you study this, the more you start to understand the patterns. Retail gets trapped, institutions collect liquidity, and launch the expansion. London doesn't follow any trend, guys. It just creates it, right? Most of the times. And then vice versa. It could shift from the Asian to the London and so forth. Now, New York session is pretty much my sweet spot. Why is it? Because distribution usually occurs towards and after during the New York session. Volume picks at US traders join. So either a continuation from the London session, move, or it reverses it. So that's where we have big spikes. Now, if you check any chart, you realize that 9 out of 10 times we have the biggest momentum and volume occurring in the New York session. And my sweet timing sports, this is not rocket science. It's not new. If you backtest, you'll realize that between 8:30 and 10 a.m. from data releases on fundamental news is where biggest moves happen. Now, you might want to rewatch this video. I will save the recording so that you interpret this. I have an open question and answer opportunity. Now, institutions exit positions during New York, and then we have sharp moves and then slow feds. So what runs early often dies by lunchtime. Now, we also have New York from, say, 12, right? We have 12 to 4 p.m. That is noon to 4 p.m. of New York. That is where we have reaccumulation transition, right? That is a transition where we have market cooling, orders rebalance for the next day. They're very slow, controlled, and very quiet reversals. You don't get crazy reversals like you would get, say, in the previous session. So the cycle resets and new traps, new liquidity, and so forth. I'll save a nice document for you. If you're interested, just DM me. I'll send you a nice one. I've made it in a way that it's very user-friendly and easy to understand. This will give you a nice perspective when you're trading. Now, every candle you trade is part of this choreography. I like to call it choreography, right? Because, like people are controlling the algos. They have a set target and they need to engineer that. Now, Asia writes the script. In my group, we have simulations where I show you some of these things, where London usually acts it out and New York signs the credit. So once you see this rhythm, this dance, you stop trading candles. You start actually trading with intent and information. Now, let us take an example. Let us look at gold. All right. Apparently gold is not really doing quite as I expected this week. Let's take Euro USD, a very simple chart. And very quickly you will see that you can look at where the equal highs and the equal lows. Look at the time. Here it says okay, there you have it. Equal highs, equal lows, right? This is usually Asian session here. We're having the Asian session, all right? And then we have institutions don't want to buy with you, right? They want to buy from you. So they'll push price just below these lows. As you can see, some spikes out, spikes in, and, they'll trigger panic and then instantly reverse. So a template for every instrument as you trade, you'll be able to record this, understand your instrument very well. So once they push price out or just below these lows, triggering all the panic, that is called a liquidity grab. And they usually come back for it later on. You've had terminologies like stop hunting. These are deliberate moves to collect liquidity and build institutional positions at optimal pricings. Now, types of liquidity. Very quickly, we have external liquidity, External, these are visible liquidity beyond highs and lows. If you extrapolate that to say a 4 hour, you could see below highs like this one right here, right? Below lows like these ones, right? These are classic double bottoms, like you see a double bottom, double top. These are traps. Institutions just push price there and they trigger pending orders right there, and then they bring it back down. When you're looking at internal liquidity, on the contrary, these are smaller and hidden imbalances inside structure. Now, inside structure, you could go to the lower time frames like 30 minutes and you could identify internal liquidity like these AB points, right? They are created within consolidations usually, or we call them micro ranges. Institutions usually clean these during continuation or retracement phases. And we also have dynamic liquidity, usually generated in real time through emotion and volume. These are what we see when we're doing fundamentals. If you scroll back, you'll be able to see and just get a bird's view perspective of how I trade. Dynamic liquidity happens during news spikes or false breakouts. Now, when you understand which liquidity is being targeted, you really stop guessing. You stop guessing direction. You start anticipating moves. Market structure now. Looking today, today we don't have anything once again. It's a slow Friday. Besides GDP Canadian, we have come to the end of the week. By this time, I expected you to lock in 80% of your profit and start reading with intent. Institutional, if you look at the Euro USD, we go to say a 5 minute, right? We could easily see breaking of structure right here. There is some structure. You don't even need any lines. You could just see it with your naked eyes. Structure has been broken. We have a change of character. You usually hear these terminologies. Change of character. You know, somebody has a good mood and all of a sudden the mood has changed. You have to ask yourself, why? What did I do wrong? What happened? Did I, or rather, is he fine? Is he or she sick? What's going on with the mood? So those micro mannerisms are very important in price action. We have the same thing. Institutional structure is some kind of language. It's a language. It speaks highs and lows and imbalance. So every break of structure or change of behavioral character isn't a shift. It's an announcement of intent, and it's our duty or job as traders to read that. Now, accumulation. Once again, quiet, very sideways, like here. Let's move to the 1 hour. There you have it. Quiet, very silent, slow volume. If you open up an indicator with, say, volume indicator, with volume you could just simply use let's see, you could use anything, even MACD. MACD is usually fine. You could see the volume right here during that time is very slow. You know, retail usually loses patience here. Institutions are loading up. And the bigger time frames indicate much bigger accumulation. Now, manipulation is a sudden breakout of this range. You see that? This candle is with intent. It moves out of that range. Look at the time. It's about, this is London time now. Asian time, London time got out of the range. Sudden breakout. It's a false move usually. And designed to trap the breakout traders. So everyone that was selling in here is now trapped. Distribution. All right. After profit taking, they usually profit take up here, as you can see. They've taken profit. Then they distribute. they distribute, taking out, wiping out all that. A new profit taking, new liquidity zones are formed for the next phase. So this kind of cycle repeats itself over and over endlessly. Accumulation, manipulation, distribution. it's a heartbreak of market making. A heartbeat, not a heartbreak. Yeah, a heartbeat. It's like your blood boiling, pumping. It has to keep going on and on and on and on. Now your duty is very simple. To understand your instruments, I highly advise and recommend not more than 3 instruments. Get perfect at them, backtest, and let's be honest. Most traders believe markets are random. That is a fact. You find people with crazy indicators, so much noise on the charts. Most people really, they really do believe that markets are random. They're not. And I can prove that. The illusion of randomness is the design itself. You see, when volatility is low, like today, okay, the algorithms are controlling. The bots are controlling. Liquidity distribution slows down. These points are not random. They're mathematical expressions that have already been input. Now, the algorithms control these liquidity distributions. They slow down during these low volatility times. When volatility increases, like you can open up any fundamental day, they also expand the range. So ranges expand, right? They widen the spreads to harvest trapped liquidity faster. Everything you see, guys, everything you see on a chart, from fake breakouts to indecision candles, is called data engineering. The market is a liquidity engine. It's just disguised in chaos. Now, if you internalize this one truth, right? Price moves to find liquidity, not to confirm analysis. Price is always moving, all right? It's always moving to a liquidity zone, to the highs and lows. And that's where we come with the terminologies of support and resistance. There is something magnetic around those points, the lows and the highs. Your entire trading psychology shifts when you understand that. I know it's a simple concept. Many of you might have even heard of it or even learned it, but the more you start to practice, the better. So ask yourself a question. How do institutions see your order? How do they see your order? Your entire... All right? How do they see your orders? When you click buy, when you just click a buy now, like right now, randomly, if you just click buy, this buy, or sell, whatever you want, first the order goes to your broker. All right? Your broker is very important. If your broker is fraudy, isn't licensed, doesn't have any care for their client, that is the first mistake you're making. Now, me, I use pocket options. It's proven time and again. I haven't had any issues with them. If you have a trusted broker, the orders are then sent to a liquidity provider. So there's a hierarchy. After the broker, you will find a liquidity provider, and they simply aggregate flow, often under an algorithm designed to maintain equilibrium. Now, there's a lot of hedging in and out there, but when thousands of retail traders are buying at the same level, like over here, if you shift this down, hundreds of retail traders are buying at this level, let's say it's gold or whatever instrument you're doing, right? It becomes visible liquidity. Institutions then like to fade that flow, right? They come and take the opposite side in order to rebalance the book. That's why price often reverses immediately after confirmation candles. Your confirmation is their exit liquidity. As simple as that. So guys, I know it might be very hard for some of you to understand this, but the advanced group that has been trading for a while, and you kind of get the picture. For the newbies, I've composed a very nice PDF. Just join me, send me a DM, and I'll send it to you free so that you could practice this. So the next time, whenever you see a clean breakout like this one here, ask yourself, who benefits if I enter here? Really, if you enter right now here, who is going to benefit? If the answer is the algorithm, just step aside. Simply step aside. In quiet markets, the institutional game is subtle. Very subtle. You don't even recognize that. You think it's between retails. That's why I have structured some of my streams in a way that exposes some of the tricks and diversions that they have. Looking at seasonal performances, looking at your highs and your lows, all right? You see, we have highs and lows here. Checking out your true highs and lows, looking at your commitment of traders, right? What are the commitments from the institutional perspective? You know, adding real fundamental data from the official websites like Consumer Price Index for the US, looking at the statistics from some of the major currencies, looking at your alt, your Bitcoin index. All this plays a big role in your perception. You can be able to correlate. If you now get onto the correlation analysis, looking at how bonds are affecting some of the indices, and you're looking at some of the top companies and how the flow of money from stocks into retail comes in, or some other baskets. These all are very important when you're looking at the markets. So just know that some of these moves, or rather big players, are not chasing volatility. They're just engineering imbalance. So here's how they operate, right? To cut the long story short, how do they operate? Identify where liquidity sits, right? Where is liquidity sitting now? Where is it? It's much probable that liquidity is right below 1.149, and in this time frame, the 1 hour time frame. Now, they usually build zones where traders expect breakouts. There was an expectation of a breakout right here. They kept building it, they kept going lower, and then they pushed the price up. Now, they create false confirmation. As you can see, double bottoms, right? Double bottoms extra. These trigger your stops and make new imbalances. Now, don't forget, this is just one perspective. We also have the weekly high and low. We have the monthly high and low. You have to have all that in consideration. Look at the past 15 or 20 days. Get the equilibrium point, the highs, the lows, etc. Now, once they've created a false confirmation, they absorb orders. They transfer liquidity quietly, candle by candle, slowly up. They build alignment for future moves. So, don't forget, they just don't get in and out. They hold positions over the weekend, over the months, depending on their strategy. This is how entire weeks are structured without news. So quiet markets are in absence of volume. They're controlled volume distribution. As simple as that. That's why I teach patience, guys. If you've noticed on most of my streams, or rather my interactions with socials, I always emphasize patience. It's the ability to wait for institutional footprints to fully form before reacting. Whatever you see me doing with scalps of 10 to 15 seconds, these are mainly informed decisions, informed strategies that work out. You could use technical analysis, but you have to have the background information running about institutions. Because when a move happens, that's when you could effortlessly effortlessly get out of positions because you understand what has gone south. All right. Now, institutional footprints, if I'm looking at the Euro USD, nothing much right now at the moment. We are waiting for, continuation. If you look at the daily, yep, there we have it. Euro USD is a very stable one. We didn't have much movement. As you can see, the high was over there, and we have the low. So nothing much. It's a really chaotic chart. We shall move to the Euro USD card. Now this one has much more potential. It has a lot of potential to give us some profit. Not a lot, but to play around with. So we have a high and we have a low. And as you could see, the price is moving towards the previous low here, where we have the support. And price could actually come way down here. But you must put in mind that it's a Friday and we could have a pullback all the way till the consolidation zone. Now, after mapping this out, you want to look for footprints. Subtle but very visible once you know what to look for. For example, when I look at this chart, I want to look for wicks. Representations of rejection. Where could the wicks be? We have some wicks right here. Right? Absorption of liquidity. Do we have any wicks here? Do we have any exhaustion coming in? Next, you look for imbalances or whatever you want to call them. Fair value gaps or FVGs. These just show inefficiencies left from institutional execution. Now, if you include some of the indicators like the Fibonacci retracements, okay, so we have a high there. Where is it? Let's get the Fibonacci right there. Let's get the Fibonacci right there. Got a high and a low right there. So price could actually come all the way to the 6.1, but very highly unlikely for today. Now also look at volume divergences, right? MACD is a good one. You could look for how volume spikes without following through, and that is equal to manipulation. If we have spikes, if you look at spikes here between these two vertical points, we have price right there. We have spikes coming in and out, but you have no significant change in volume. That is a big red flag. That immediately shows you that there's some kind of manipulation going on. And if you were buying here, there's a high chance that you will get caught off guard. Now, all these simple little gems help you make the right decisions. Session timing is the most important whenever you're trading. Institutional footprints, they cluster near session opens, closes, especially the London, New York overlap. If you have that overlap between London and New York, you'll be able to highlight what's going on. Now, if you combine timing, liquidity, and structure, you literally see where institutions left their fingerprints. So, whenever I hear you're gambling, that is just an informed person, right? Trying to just, elaborate how uninformed they are. If you combine the right strategy with the right mindset, the right background information about institutions, you'll literally see where everything is happening there. Fingerprints. So you'll not predict, you'll just read. Now, let me leave you with this thought, guys. Today, I don't see anything. I don't see any hype. We've made a bunch of money this week, and we will wait for one last session. Just join my community. So I'm not rushing to make any trades now. I just wanted to share this burning lesson, and it's a very big lesson. We'll be dissecting it over the times. Like, I'll be sharing with you once in a while, but I want to engineer it in a way that you have an understanding of each of these definitions that I always share in my group. Let me leave you with this thought, guys. Retail traders see price as movement, okay? Smart money sees price as structure. Ask yourself a question. What is your goal? Your goal isn't to predict. It's to interpret. Learn to identify liquidity intent. Understand volume, the volume rhythm, and respect timing. It's very important. When you stop reacting to every candle, you start understanding their engineering, like every candle, break it down into the smaller time frames. You could use 15. 15 is a good one. Check out what's happening down. Do they have wicks? Understand the engineering. That's when you stop being prey and you start trading like a creator. So I'll upload the free institutional flow map for you. It's a PDF that I've designed. I've gathered all my, my thoughts, and I'll help you visualize how liquidity cycles actually run. All right, and how to pre-position intelligently. Once again, guys, this is the Tony Trades channel. Use the T-Stream promo code and get 100% on your fast deposit. We're not playing games here. We're going straight to the gems. It's proof of work on my channel. I believe in walking the talk. Don't just sit down and, pretend like you know what you're doing. Come along. We have a community, a growing community. We discuss a lot of financial market breakdowns. We look pre-market analysis. We have a lot of tools, and most importantly is risk. Risk management is by far the most important whenever you're trading. If you're still doing things with no understanding of risk, you are making a big mistake. Now, we have some moves coming up. So price is refusing to break this point at this 10 second, 15 second. Oh, and another thing, on Fridays, I always use a 10-second timer. And there's no better place to use that tool, but using it on pocket option just makes it much better. So we have lows there. Let's just quickly, I might get a trade for you. Oh, there we have it. We have the pullback. And just as I said, we could get a pullback all the way up, and that could be a fake. Now, if you want to fade this, you could go with it, all right? As always, switch to the percentage. You want to risk 1%. 1%. In my view, that will be $464. And you want to use the 10-second or 15-second, right? If it taps one of the moving averages, you have clear confirmation that price is not being manipulated, volume is around, and you have a context from the weekly perspective. You could actually buy. Let's try and buy that. Let's see what happens. You see volume is coming up. New York session. Oh, there we having some trouble there. Well, there you have it. So we have one loss right there. Again, with losses, guys, you have to be very calculative. Price will surely move up. On a Friday, you don't want to risk anything significant. As you can see, 1% means nothing. If you have the martingale strategy, I actually pinned this in my Telegram channel. You want to check out the martingale. I'll just share it with you. Martingale. There you go. So we have the martingale file. I'll share this with you all. You just simply you could put in the amount that you want to risk, and it will give you the number of times. You could do that multiple times. I love it on Friday. It doesn't waste any time. For example, you've used 1%. You could increase this by, say, 1.5%, or rather 1.5%. and what happens is you end up getting back all what you lost. So in this case, we have another buy. Let's see what happens. All right, we got 10 seconds. And there you have it. And you can call it quits for the day, right? You don't want to rush. You don't want to rush with these Friday games. You want to look at momentum. Nevertheless, I'm just showing you, running you through what we do. We will have a serious session coming up, so join in. I don't want to take much of your time. Smart money is very important. If you'd like to know more, I have a visual segment guide for you showing exactly what should appear, how I look at the market, how I enter. Until then, guys, next week we're going to decode how smart money builds momentum in silence. Stay liquid, guys. Stay disciplined, and always think like institutions. Stay safe. Not a bad week so far, and see you in the